Okay, it's 9 o'clock. Can we call the meeting to order, please? Deborah, roll call.
Certainly. Ring.
Here.
Star.
Here.
Castile.
Here.
Hines.
Here.
Jennings.
Here.
Singh is excused, and Byron.
Present.
Great. Next is the approval of the minutes from the regular meeting on June 24th. Anyone have any additions or changes? If seeing none, they're approved as sent out. The next is the election of vice chair, and I'm going to nominate Kim Starr for that. Is there any second?
I'll second.
Second. Any other nominations? Otherwise, I move they be closed. Deborah, can we get a roll call vote real quick?
Okay.
I am sorry. I was assisting Ken.
Yeah, so I nominated and Cheryl,
Thank you. Aren't you just
second.
so ecstatic? This is wonderful.
And if we
And then
can
roll calls, Ring.
Yes.
Star.
Yes.
Castile.
Yes.
Hines.
Yes.
Jennings.
Yes.
And Byron.
Yes.
And Dan, who seconded?
Cheryl.
Who'd you elect?
Oh.
Kim.
Under show, yeah.
Nominate Kim.
Thank you so much.
Next is members forum. Any members?
Are there any members present who'd like to speak? No. And there are no members online who wish to speak. That concludes the member forum.
Okay, next is my announcements, just two quick ones. One, welcome Cheryl and David to their first official meeting. Look forward to working with you for the next 3 years. And then secondly, because we have an outside visitor, I'm going to skip around and we're going to let Ken from Gallagher go next. If Deborah has him ready.
I'm
Just
sorry.
one
More
second
minute,
here.
whenever you're ready.
This is check your email.
Jeff, do you want to give your comments?
Sure. Real quick, first, welcome to the new members. Look forward to working with everybody. One of the items that was discussed in relation to the agenda was the use of KPIs for the development of the 2026 operating budget. There is an item on Thursday's board agenda for their goals, and one of the goals of the board is to begin identifying and implementing methods to measure the use and effectiveness of community services programs and amenities. So developing KPIs for our programs and services and amenity usage. So I wanted to let that process begin before we really dive into it at the finance committee level. Some of the projects involved in that will be to evaluate and determine desired outcomes based on the use of metrics for amenities, programs, and services. So what are we intending to do with this information once we gather it? How are we going to use it, report on it, make decisions with it? I think that is really a key first step based on kind of our unique setup as a community service organization. Once that's done, then we'll develop the tools for collecting that data and the appropriate metrics, and then we will start to develop those reports and bring them forward to the various committees and the board as well. So I have a multi-step process, but something we definitely will begin with the board goal on Thursday.
I have a question, Jeff.
Yes.
So does that mean that you'll then solicit input from various committees about what they want to see?
I think that'll be a key portion of that process. That's it.
Okay.
Your email address and your name, that's it.
Do you want to have Ann go while we're still?
I see it close,
Very close.
very close.
We can feel it.
We're just 1 minute away.
I can give a little preamble to Ken's presentation here. We've already begun working with Gallagher on renewals for 2026. The insurance task force of mutual presidents and Adrian has been a part of that, has been meeting and discussing a number of items related to the renewal in terms of moving our renewal date from 1/1 to a 6/1 date. And in terms of coverage and levels, today we'll be focusing on the RWC property and coverages, as well as some earthquake options. Currently, we have 5 million in coverage just for the RWC amenities and property. Ken's gonna go over a few different options related to that as well.
Okay,
Ken.
you ready?
I wasn't, yeah, I'm ready.
Okay, you're up.
All right, here we go. So the book that you should all have in your hands, it's got a few different presentations in it. So I didn't want to have folders where you guys have different ones. I wanted to give you one document so that you could keep it. It would be more convenient. So as we run through this, there might be a point where I ask you to, hey, stop and let's flip to another part of the book so that you can look and evaluate what we're presenting. For some of you who might be new to us, my name is Ken Johnson. I work for a firm by the name of Arthur J. Gallagher. A lot of people refer to it in the insurance industry as just Gallagher. We've been in business for approximately 100 years. We are the #2 largest insurance broker in the world, recently having passed Aon. And it is always a privilege for Gallagher and myself to get to speak and address Rossmore. You're a very highly valued client of our firm. So on page 3, and as you open this, I took the table of contents out because we're going to be bouncing around a little bit. It's a little bit about our firm. We're publicly traded on the New York Stock Exchange, do business in countries around the world. I think now we're up to 150 countries. And it's it's a big firm with a lot of resources. The next page shows these are different divisions that Gallagher has, from our reinsurance group, Gallagher Re, Risk Placement Services. Artex is our captive arm. Gallagher Securities does insurance-linked securities. Gallagher Bassett is our third-party administrator. RPA is our risk placement, that's for group programs. So a lot of different entities, and many of the entities that you're looking at here, Gallagher, RPS, Artex, Gallagher Re, they all work on your account. They all touch Rossmore in one way or another.
Did you not want to present over? If you don't want to present over Zoom, I need to close it down because it's making the screen dark.
I don't know how I can talk and move this.
And manage that, okay.
So everybody can get the report afterwards. I can send Jeff.
Absolutely.
One of the tenets that so Gallagher, Bob Gallagher, came up with this about 34 years ago, and it's just kind of the rules of the road for the way we treat each other, the way we interact with our clients, called the Gallagher way. And it's one of those things. It's kind of interesting. It's part of our culture, and that's, I think, what's made Gallagher so strong. One of those items in here is, we adhere to the highest standard of moral and ethical behavior. Some of the things that I'll share with you guys over the years, because the insurance marketplace goes up and down, you may not want to hear. It's like, hey, that's really bad news, for this type of class of business. But I'm always going to give you guys the absolute truth. So whether it's good or bad. So I always throw that slide in there. Jeff Matheson goes to a meeting with me. It's called RIMS. Many of you are from a CFO, treasury background or finance background, and you may have attended RIMS or had people that work for you attend RIMS. It's a meeting that takes place in a different city around the country every year, and all the insurance brokers, insurance carriers, syndicates, everybody in the insurance world, the risk world attends RIMS. Jeff Matheson was there for the 3rd year. And I think it's really taken the Rossmore property insurance program and really solidified it. Because what he does is he gets to meet face to face with the key individuals that are taking the property risk for Rossmore. Some of those people that you can see on the next page are, Zurich, the biggest insurance companies in the world, Zurich, Munich Re, Mitsui, the Hartford, Sampo, Swiss Re. These are all insurance carriers that have taken a position on your risk portfolio. The London syndicates, Beasley, London, that's the biggest London syndicate that there is, one of the biggest insurance operations in the world. Simon Wilson, when he comes walking into the booth to meet Jeff, he's like, "Hey Jeff, how are you? Good to see you again." I mean, the relationships that he has formed with these people is interesting, and they really admire Rossmore because of what you guys have done. They know exactly. The next slide, each one of these individuals, whether it's an underwriter from Zurich or the Hartford or Rachel Soares from Chubb, Bermuda, she knows exactly about the shaded fuel grade. She knows about the ember-resistant fire stops because Gallagher, our team, is constantly feeding this information to underwriters about the work that you guys are doing, the infrastructure updates to the electrical panels, to the fire stops, the CAL FIRE 2025 fire hazard zone, how you guys improved. So they're all familiar with that. And to the point where, they just really like the account. Rachel Soares, you saw that name right there in Chubb, Bermuda. She puts up $605 million worth of property insurance for Rossmore. And as the meeting between Jeff and her was rounding out or winding up, she says, Jeff, if you wanted to, I'd like to offer to you now, we could extend your property program for a period of 3 years with a guaranteed 5% year-over-year rate reduction. It was a telltale at the early part of that RIMS meeting that the property market has changed. And he just looked at it, he was very kind about it, but he looked at it like he was playing poker. Like, yeah, I know, Rachel, and maybe if you were at 20%, we might have something to talk about. But anyway, it was indicative of the way the marketplace is going. And so we're, after many years, 5 years, it's just a brutal marketplace for the property world. So, what's going on? What should we be expecting for January 1 renewals, and what took place on June 1, 7/1 renewals? It's less hectic of a marketplace, and so we are traditionally on so leading up to one of the crux of the changes that we're going to be talking about. We're always all lines of insurance are on a January 1 renewal. And that's a very difficult time of the year. Many of you are from a finance background, as I said already, and you would know, hey, that is not a good time to have as your property and casualty renewal, because 60, maybe 55, 60% of the major commercial accounts renew on that time frame. Insurance underwriters are waiting for approval of their rates. So they'll say, hey, you know what? I'd love to issue my quote, but I can't because my rates haven't been approved at this point yet. Not so much for the property, because a lot of the property is non-admitted, but for the other lines of business, your GL, your workers' compensation, things like that. So that's a problem. So one of the concepts that we were discussing that we're moving toward is moving away from that January 1 date to a June date. By doing that, it also avoids wildfire season to a great extent, even though wildfire season can be any time now, but traditionally it was at that latter part of the year, as well as hurricane season. right? So it's not, they don't have that to affect their reinsurance. So a June 1 date is a more preferential date than a January 1 date, especially for a community like this, where you've got many people that need to be involved, and Christmas time, the holidays aren't necessarily a great time to be doing your property and casualty renewal. This next slide shows the process for which we would go through. So right now, really, it starts with RIMS. That's the kickoff of our renewal, when Jeff is meeting with each one of these underwriters, making sure they understand all the different things that they're doing. And so now we start with the renewal process. Our team, led by Sandra Moreno and a few other people, will be starting to work with Todd and his team to gather the information for the January 1 renewal. Each one of those underwriters that we met with, Jeff was like, hey, I'd like to float this concept to you. How would you guys feel if we were to move off a January 1 date to a June 1 date? And they were all very supportive of it. It's like, whatever you want, Jeff, whatever we need to help, whatever we can do to help Rossmore, we think it's a good idea. So there was no pushback. Nobody had any issues with that, because let's face it, you're a very profitable account for them. And so the renewal extension would run from January 1 to June 1, 2026. And so we would expect a rate reduction on January 1 for the premiums. And then our big renewal process would be, we would, as shortly after January 1 on 2/1, again, Sandra and her team and myself would start working with Todd's team to process the renewal for June 1, 2026. And then at that point, you'd be sitting through the renewal presentation on 5/10 for the renewal on the 6/1 date.
So this is a significant budget issue that we'll be talking about here coming up. 'Cause we're looking at a renewal period and then a full 12-month period. And looking at what the rates are projected to do for both the renewal and the new policy year, along with the fact that all of the mutuals and RWC budgeted about 20% over what the rates were this year. We think that we can accomplish all of this and still keeping the budget flat. So ultimately you will see the savings down the line, because you're going to be paying next year, but we can do it without seeing a spike in the budgeted amount.
So I have a question. So if rates are going down, and we expect them to be going down for the next few years, is that right? Or did I misunderstand that?
Property rates are on the decline. That is correct. Yes.
So if the insurance companies are doing their rate tables or whatever it is they do in December for the following year, will we be re-rated mid-year, or will it be based on the previous year's rates? Because what I'm concerned about is that we're locking in for a 6-month time period a higher rate than we would otherwise have to pay.
Yeah, that's an excellent question. That's an excellent question. You're kind of straddling a hybrid between like a work comp policy, right? Which is fairly static in their rates. Let's say you renew a workers' compensation policy on January 1. Those rates, they don't fluctuate as much in the marketplace as does some other lines of business. And so in that case, you're locking yourself in a work comp policy. It's difficult to move that rate. Property, when it's especially now, right? You are seeing people fighting for position. The key word out there is capacity, right? Let's keep in mind, we just saw the biggest wildfire loss in the history of the United States, right? Los Angeles, right? And you would look at that and go, boy, at the end of the day, that thing's gonna come in close to $100 billion. Right now, they're comfortable saying 65, but ultimately, when everything shakes out, it'll probably be close to $100 billion, right? Did that have an effect on the property market? Not a chance. It didn't, because insurance underwriters have gotten valuations at a point where they wanted to, right? Before they see these losses, massive hurricanes or massive wildfires, and they would look at their schedule and they say, wow, we lost 4 buildings on this account. And one was built, valued at 4 million, another one is 6 million, another at 10. In order to replace those buildings, it's gonna be 17, 20, and $23 million. All the valuations were very, very low. And so for a period of 2-3 years, underwriters required the valuations be increased. Rossmore was one of those, right? We had to engage in our Kroll appraisal, and we're finishing our 3rd year of that right now. So valuation is where they want, and rates are where they want. So that's where you didn't have a hiccup. The problem is, or not, not the problem, the advantage that you have now is these insurance companies are making a lot of money, right? And so we want to take advantage of that. And so, you know, in property, you can, it's more flexible. You can move because you remember you have 60 insurance companies on your property insurance portfolio right now. Some of those people will say, well, I'm not going to change my rate. Well, that's fine. You don't have to change your rate, Ascot, because Beasley will take that capacity from you, right? So
the answer is yes, mid-year, we're not stuck with previous year's rates. They will re-rate mid-year, so it's not like we're. Okay.
So we believe
Basically,
that.
they're basically auctioning the,
Okay, I just wanted to
coverage
make
off at
sure,
that
because
point.
you had talked previously about, you know, at year end and they're coming up with new rates. And so I just wanted to make sure those weren't static.
yeah, I think I stopped myself too and said, hey, more, not so much with property, but more with the workers' comp and the liability stuff at the end of the.
I think when you said they're getting their treaties and their.
That's right, their reinsurance treaties.
Capacity. So we think that when we do the extension for our 1/1, that we'll see a reduction in the overall program. Additionally, we think we'll get additional relief 6/1. And then that will carry us for that year. So between those two and what we already saw in savings year over year this year, that's where I think we can budget flat and have the capacity to do both, to move us permanently to that 6/1 date.
So then it's just a matter of coming up with the cash. Yeah, even though the budget part is gonna be flat,
Yeah.
we're gonna need more cash.
yeah, and I think to compound that, you know, we all know that the mutuals are all, they basically have a structure, so they're kind of paying in arrears. So obviously, I've already started on this modeling because it comes down to modeling out that cash through 2027. And we'll talk about why the forecasting is so important on that cash, because it'll be easier for some than other mutuals to make this happen. And so we need to look at the ability for them to, you know, so very much top of the list for the budgeting for next year.
2 questions, Jeff. One is budget flat based on the 20% increase that you said the budget was based on, or at 100, or, because that's a 20% increase then. So that's not flat.
So year over year budget from 25 to 26 would be flat.
Which, and 25 had a 20% increase from 24 built into the budget.
Oh, yeah.
So 24 was.
So you're
So it's
seeing.
100, then it went to 120.
20, and then it's gonna stay at 120.
You're gonna
So
say
I thought it was gonna come, you just said rates were decreasing, so shouldn't it be coming down?
So if we need to budget for the 6-month extension plus a year renew, so we're budgeting for 18 months instead of 12 months.
So it is a reduction.
That 18 months, we think we can come in at the same rate as the 12-month.
But the budget's still gonna be just for 12 months, it's gonna be for the same 12 months.
But you need to pay
Understand.
that.
Okay, all right, that's
You need to
one.
pay it during that term.
Okay, and then secondly, is there any foreseeable future where we're 100% covered, so we get Fannie Mae and Freddie Mac loans?
So I don't think we'll ever see a day where we are 100% covered again through traditional methods. We've looked at other options, but the capacity still, we're at 1.3, we're talking about between 1 and 1.3 billion in coverage limits, and we're at 2.8. valuation. So our ability to seek an additional 1.5 billion
Double it.
just,
Double the
it
cost.
doesn't make any economic sense, and whether capacity is there or not. So we need to continue to work on alternatives to that issue, whether it be legislative initiative, whether it be through other forms of coverage, but traditional doesn't look likely.
Okay, and are other clients having the same issue, where they're not being covered 100%?
Yeah, it's a concern across the United States, right? Whether it's wind on the East Coast or it's flooding in the middle part of the United States, and now it's even affecting with convective storms. Yes, it's a big problem for master plan communities. I'm very familiar with it, and there is not enough capacity to build out for older wood frame, somewhat non-sprinklered habitational at $2.8 billion. There's just not enough capacity in the world, and the cost would be very high. Because just one little idiosyncrasy, you say, well, geez, at that high level, if you don't think we're gonna have a fire, then why would that insurance not be really, really cheap? It's because they've got that capacity. Let's say it's a Beasley or
Yeah, they're giving it to someone else.
they'll drop it back down and they'll charge that rate down here, right? This next page is, for some of you that are new to the committee, this is a schematic of your insurance portfolio. There's a lot of insurance that you have here. It is, we could go through this at some other time, but over there, you've got your crime coverage, cyber liability, D&O, employment practices, and then the property tower. I couldn't fit all the different carriers in there. We do have a 5-year alternative risk transfer program with 85% of that premium returnable to you. You guys are sitting on $7 million in the bank now earning interest, which is fantastic. That's done exactly what it was supposed to have done. And so it gives you all different types of alternatives and flexibility as we finish this year out. We carry a $250,000 self-insured deductible on the property insurance. Everest is a workers' compensation carrier. They're gonna get a significant amount of competition this year. Everest, they've kind of changed some things. So don't be surprised if you see 3 or 4 carriers come in on Everest to replace it. The liability insurance, from a finance committee point of view, you need to know, this is the next hurdle in the insurance world, liability insurance. Liability insurance is going through, it's private equity has found its way into the liability, into the litigation. They are funding litigation. They're lending money to the bars associations of Florida, New York, New Jersey, Pennsylvania, Texas, California, giving attorneys money to do advertising on television, advertising on print, outdoor. And then they're also using AI to find people that have recently been let go from their employment or been in any type of accident, and they find those people, and then they try to incite litigation. And so people that in the past had not necessarily been able to carry litigation through to a jury trial, now they have funding to do that. All the private equity wants to do is get that case in front of a jury because of these potential nuclear awards and nuclear verdicts. And so underwriters umbrella underwriters who traditionally said, I'm sitting 15x of 10, I might see 1 claim a year. Now they're seeing 13, 15 claims a year penetrate that layer. So the liability world, talk about having politics involved. There needs to be some type of tort reform, because this has become a big problem. The reason I'm mentioning this to you is Great American puts up this 10 million here over the primary. They're gonna drop that to 5 million. We will have competition. Maybe Philadelphia will come in and pick up the 10. I doubt it. So we're gonna have, that layer is gonna have, it'll be broken in 2. It'll be Great American 5, somebody else will be 5. XL, they're putting up 15, they might shrink that to 10. Before, on that top layer, before last year, we used to have Liberty Mutual putting up 25 million. And now you can see what happened to do that. Now we have many different insurance companies up there building out that capacity. to get to the $50 million limit. And then that last thing is just your equipment breakdown coverage. I know this is a complex slide with a lot of information on it. Is there any question before I move forward on it? And that takes us to a subject that Jeff wanted me to speak to, earthquake modeling for trust facilities. So the trust facilities have a total of 112 million. This report here, which you can flip to in your documentation, it's a modeling, a risk modeling report. And what it does is it goes into detail. And basically, it shows everything about soil conditions, what they believe that an earthquake that is closest to Rossmore what would the damage be for both shake only and shake with sprinkler leakage. And so basically, to cut to the chase on this, they're saying, hey, if there was an earthquake on your closest fault, we anticipate probable maximum loss for within a 250 to 500 year return period, which is what they use. They don't use years, they use return periods, is $25 million. So they believe that the damage to those locations would be somewhere between 18 million and 24. I'm using the high number, 500 years. You'll find that on page 8. And so $25 million.
Is that within this book here?
It's in that book.
Eight
yeah.
in the book,
Yeah, it's
right? Yeah.
13 in the book.
Well, it's 13, yeah.
Yeah, you gotta go to
The
this.
summary's 13.
It's under the cat risk consultant report through RWC.
It's like the second blue tab.
Yes.
Yeah, second blue tab.
It's like this behind the blue tab.
And the summary is right behind it. The first one, I put it on, I just
Yeah.
snapped a picture of that, right? It's $25 million. So,
And that's page 13.
so there's traditional earthquake insurance. And then there's a new type of insurance out there that's kind of changing the world. It's called parametric insurance. I don't know if any of you have seen it. The parametric insurance is being used by developing nations a lot in Africa for crop insurance. It can be used for wildfire insurance. It's used for quake and it's used for wind. And it's typically, it's targeted towards catastrophic losses. And there is a separate package. I stuck this in there just so you guys can all read about this. This is one of the insurance entities that does parametric. And parametrics, what's the difference? Why is it different? Because what it does is it basically says, this is your location, right?
Yeah, I see it.
In the event that there is an earthquake, we are going to look at the USGA documentation as to how big the quake was, what the speed of it's called a PGA. It just basically says what is the intensity that hit your location? And then it says, based upon that figure, we go to a scale and we say, okay, you carry $20 million worth of insurance. This earthquake generated number 46 on your scale. We're going to write you a check for $10 million, right? There's no deductible. There doesn't have to be any damage to the structures. It's very different. So you can use that to say, hey, I'm going to use this for business interruption because there's earthquake did something else to the the other parts of the community. And so it's basically a check to do different things. Key benefits are, number one, no deductible. Number two, speed of payment, right? There's no adjusting. You don't have to have adjusters from 4 different insurance companies come out here and look at the building and say, well, this or that or the other thing. They just cut you a check. It's customizable coverage. Oftentimes, it's used in conjunction with traditional earthquake insurance, right? So currently, we have $5 million worth of earthquake insurance, traditional earthquake insurance on the trust facilities. So sometimes people will say, well, what's that costing me? And that's costing you on the traditional quake right now, you're paying $245,000 for $5 million, right? If you were to buy $20 million worth of parametric, that price would be about $250,000. Parametric is less expensive, and it's got some really key benefits. So, oftentimes when I have a client that has one particular, they buy earthquake for all their operations, but they have one particular facility that's, $80 million, right? It's kind of a spike, like a witch's hat spike, right? And so they buy parametric over their traditional quake to cover that loss, cover the damage, potential damage to that structure.
So I'm trying to, this is all kind of complicated, but you started off, what did you say about the parametric insurance, that we're going to go to that, or it's?
No, it's an option that we'll model it. So if the finance committee, if Jeff comes back and says, okay, Ken, thanks for the modeling. We see that the trust facilities, the probable maximum loss for a return period of 500 years is $25 million. We would like different schematics, like give me traditional quake at 10, 15 with parametric, building it up to the 25. Give me different options, and then he can float it to the different committees.
Okay.
But and it's not something that you can just throw out in a meeting like this and expect everybody to understand parametric. That's why I said at my outset, I've included information here for you guys to learn about it a little bit. And they use an example in here, what would have been the payout for the 1906 earthquake had it hit Rossmore, right, with parametric. The recovery would have been, it would have had a PGA. The PGA stands for peak ground acceleration at a 46%, and that's why they only paid $150 million.
Assuming we had the buildings here.
Assuming you have the buildings here, yeah.
There's a lot of assumptions in that.
Yeah.
So this, oftentimes,
Is that 150 in today's dollars or $1906?
Ah, good question.
So this is a lot of insurance, right? This committee, you guys are made up of finance people. So this isn't something that I would just send out to the general public, but it's for you guys to take a look at. You may have questions. Yeah, it's interesting to have the public. So, yeah. Jeff?
So there's a lot of moving parts right now as we start to do some forecasting for not only the RWC, but the mutuals, working with the insurance task force over the next few months and building that budget and some options that we'll be bringing back to this committee and ultimately to the board for your consideration in terms of coverage level. Related mostly to earthquake options. As we said, currently we're at the 5 million. We'll evaluate what some of those other costs would be if we wanted to increase or decrease that coverage. So this is just a more or less an introduction, let you know some of the parameters of what we're looking at in terms of the renewal. And then we'll be back in front of you starting next month as we start to build the budget.
Jeff, I would like to see it laid out, the whole thing about budget to budget, but there's actually a reduction, and then in June it's gonna change. Like, could we see like numbers on the
Yeah,
chart with that? 'Cause
we'll
I'm
have
having
to
trouble
do a
following.
lot of that forecasting for not only this group, but for the mutuals as well.
Yeah, just a simple schedule to lay out what exactly are these numbers.
Yeah.
We have
It's on the agenda.
I'm working on it, it's every mutual is, basically keeping the same coupon as this year, right, same amount. So going into next year, and then just modeling the cash to make sure that they can get to 18 months worth of policy.
So could you just state in simple terms what the cash issue is?
So, yeah, So the cash issue is twofold. It's one, we're basically looking at cash to cover 17 months of insurance versus, right, 5 and 12. You know, when we say June, it's technically a 5-month extension with a new 12 months. So it's the cash to cover 17 months versus 12, right? Knowing that our rates are going down. So one of the things is obviously working with Zach and Ken and his team to get some really good numbers on what those actual rates could be. And then in terms of the mutuals, it'd be how do we, not increase the coupon, but keep the coupon the same rate they're paying to get to that 17-month cash window. And it depends on every mutual's cash flow where they have to borrow from reserves because, like I said earlier, they're collecting the premium in arrears. And they got unhealthy with their cash flow, years and years ago when the premium started going up, they started doing that. So it's really modeling out. So if we were to say that in 2026, they pay the same part of the coupon as they did in 25 for insurance, and in 27, they pay the same amount. Those reductions will then eventually roll forward. And so then you would like to ideally see a reduction in insurance potentially in the 28 coupon, but it's modeling that cash up and by mutual and GRF.
In my day, the insurance companies provided where you paid so much upfront and then so much over the next 8 or 9 months. Is that still out there, or is everything due upfront on this? So there's no, like, mine was usually 25% upfront, the other 75% over the next 9 months with no interest.
Yeah, that would be like, that's standard way it is now, right? If you have Travelers, Liberty Mutual on an account, right?
Yeah.
It's 20% down, 8 equal installments, 11
Right,
equal
right.
installments. This insurance is a little different than that because you've got 60 carriers. They're they're all non-admitted for the most part. It's a different type
So
of
it is
commercial insurance.
100%.
They want their money within 30 to 45 days.
Okay.
So we're
They're
still
a
gonna
different
have to-
animal.
Okay.
This is a
So
wholesale
that's-
market
yeah.
we're dealing with, not retail.
Right.
Very, very different.
Yeah, Todd, so is it safe to say that the 20% reduction that we've experienced below budget would cover to some extent this extra
That's
period?
the
of time?
idea.
And
That's where my
put-
sharp pencil is trying to get us to.
Right, other than maybe a reserve problem with an individual mutual, but we're hoping that that's
Yes.
what covers the cash flow
Yes,
issue.
yes.
Okay,
And,
and
yeah. sure.
question, once we get through this initial, we're paying for 18 months, from there, then on, your payment would be due in June?
Correct.
Okay,
And there's a lot of
so
advantage to that, as Ken alluded to, one, capacity,
it's
lower
gonna be a
rates,
cash flow
more
thing for the
understanding what
mutuals
the
too.
coupon premium is. It'll shift us a little bit in how we do our planning because we're gonna do a planning cycle that then has an estimated 6 months at the tail end of each year.
Mhm, yes, we know.
But
Takes us off the reinsurance renewals.
takes us off the
away
reinsurance
the cat
renewals.
losses.
And then it also, potentially aligns us from other, I don't know if you want to talk about that, but it's a good date to be buying
Yeah.
insurance.
Yeah, and cash flow wise, it makes sense.
It does. So there's a lot of work to noodle all that out because I'm very, very happy. I'll talk about my update in terms of, I'm very happy to have Workday planning tools at my disposal now.
So when do the mutuals understand this potential change?
I mean, it's all being discussed out there. I mean, it's not that this isn't the first time the idea is floated. I think it's, the challenges with all of them, right? It's balancing that with reserve study and, wanting special assessments and making sure that they're not just putting it onto their residents, so it's a mutual situation, but
There's a insurance task force that has been in place now for a few years that works and meets on this. They work with Gallagher. They've had this presentation. They've been talking about this concept for quite some time now.
Yeah, the only problem with the task force is that we don't have representation from every mutual.
Right. So do they send out anything as a committee or a group of people to, here's what we just found out,
They report back to the mutual presidents.
Okay.
On a regular basis.
Has this been floated at the president's forums or the treasurer's forum?
They have we just met last month with the task force and then they've reported out. So it shouldn't be a surprise
where we're going.
But what we owe them to further their discussion is that modeling.
Show me the money.
Yeah, well, that's
Jeremy
the.
Claire right now.
Yeah.
Yeah, that's a big component of everything.
Yeah, that's how we get there.
You have Zach Phil, we have a member of
Yeah.
our team that works closely with Todd
Yeah.
on that, for
So,
the insurance side of it.
Any other questions for Ken? Thanks, Ken, appreciate
The
it.
last things you guys might want to look at in this document is there's a section in here on your workers' compensation. It's really a testament to how well run this organization is. Your experience mod is very low. It's in the 80s for somebody that does what they do. It's very impressive. So compared to your peers, you guys are lights out. You're being, there's nobody as safe as your organization out there. Thank you
Thank
very
you,
much.
thank you.
We put the CEA.
Yeah, he comes back. Yeah, I was on the phone with him.
Yeah, we'll go,
I'm gonna reach out.
okay, we did 7A, we're gonna go to 7B. Okay, we're ready to resume then?
Yeah, let's get together.
We're gonna go to 7B, which is the financials, Todd.
Yeah,
7B,
7B, not to be.
The last one.
7B,
Right.
which is the financials.
That should say Rossmore Walnut Creek. Sorry about that. That is a format. There, okay. So just a couple opening remarks. Obviously, I'm gonna start with saying, we've compared to the last two versions of this you've seen, or the last version you've seen, the columns have been flipped to match the order. I think Dwight will be happy on Thursday, but the actual amounts in the first column versus the budget now, which is how the NetSuite reports come. So just from a readability, if you were to look at it from last month, last time you saw this.
Could you speak a little louder? Please?
Yeah, sorry, Janet. I know, I'm so used to my mics.
Yeah.
So we just changed the order of the columns a little bit. Actual budgets flipped to align with the actual NetSuite reporting output. So it's so it just is a little more clean in how it flows. Same summary. So I just want to speak to really where we are. We've been playing catch up, right, on the Rossmore Walnut Creek and Rossmore Property Management side. Obviously we had a priority with getting financials out to the mutuals. This last month was a much more comprehensive reporting to all the mutuals. So we are, have really turned the corner there. So obviously this is now through year-to-date June. I think that there's a couple things I want to speak to about the actual couple variances on RWC. But I just want to say overall, this is kind of like really the springboard to getting into budgets and really looking at a forecast for the year end, right? We just got the June numbers. We will be, I'm shifting my focus to Workday and to being able to actually do an accurate forecast for the year end. As we've talked in the past, this is, budget through June, first actuals through June, right? So some of the variances, just like we've talked in the past, are due to budgets being populated with 1/12 and being a linear division by month. So some of the things like we'll see with like the streets and stuff like that, those expenditures were expected to happen in the fall. So you may see a surplus that is not necessarily going to be a surplus at the end of the year due to timing. And that's one of the reasons that at this point in time, the forecasting for year end is going to be so important. So by the time we sit here next month, we're going to have a forecast for year end as we're quickly approaching the first draft budget on September 1st on the calendar. Okay, so yeah, go ahead.
So we don't have the timing in the budget and we
yeah.
don't have a forecast process in place yet, but
Well,
so-
process we do.
So that's kind of what I'm asking is, so how do you know that we're okay if everything's timing? Like you must have some way of looking at the various.
Yeah, because I mean, I honestly look at there is some just gut knowing what's gonna happen. In terms of the actual process, and you compare it to prior years, all this data is already in Workday. And so what Workday does is immediately copies a working budget, we call it, in Workday. So it takes the first 6 months actual, and then it applies the 6 months remaining budget into a by month. And so then what we're gonna do here from a process is, we'll go through all the department heads and look at those last 6 months and move those dollars around to come up with a real number, right? So when I look at the healthy surpluses compared to total and what we've done historically, Nancy, we're in a good place. There's no big surprises unless there's some act of God that's gonna happen out there. We kind of know what our budgets are. We know what our expenditures are. There's just some timing issues, but the budgets as themselves as a whole are still very valid, right? We're not seeing huge overspending in any one area, especially when you look at the RPM side, most of it is payroll, right? And so, some of the revenue issues, that we have some timing on revenue too, with like golf and some of those things, you'll start seeing those normalize as we go through the year, right? So those are kind of coming into a little more into their normal pattern and catching up. But I would say, our goal certainly for next year, and I'll get to when I talk about NetSuite and Workday in my update, is really fine tuning that budgeting seasonality. So we have more and more accurate numbers as we go month to month versus just looking at the end of the year, right? One comment I want to make on this. So if you just look at the top levels, right, we budget to be break even. So through June, we are actually at 394. That does speak a little bit to the non-seasonality in this budget, right? Because you would think that you would have some more peaks in value based on timing. We are $656,000 ahead of where that number is. I will say there is one thing that did come to light. And I also just want to take this opportunity. I think most of us all know the amount of effort my team does, and you look at the amount of effort Amanda puts into getting all this work done. We did bring on a new senior accountant, Kat, on the GRF side, who's really starting to get up to speed now, which has been a huge resource for us. It was a tough month with illness going through the department up there. So just hands off to my team with all the hours they put in. The one comment I want to make on a variance just for everyone for this month is if you look at, I'm going to go to the detail real quick.
Before you get to that.
Yeah.
Before you get to that, the top line here says gross profit.
Okay, good. I had that question.
And that seems like, wow.
We're
That's
making
really-
money. Shouldn't that-
I think you mean, isn't it
Yeah,
really
okay, so-
revenue?
All right, so I understand that is actually just the accounting term because we have cost of sales in there. And it's also aligns itself with NetSuite terminology. It's certainly not profit but it's not actually net income either. And it's not net revenue. You could call it net revenue, right? But we do take COGS off, which is why it's gross profit.
All right.
All right, okay, so we're stuck with that term, because that's.
We're not necessarily stuck to it. We can go in eventually if we want to come up with a better term. It's a technical accounting term that's right, but it doesn't mean it's necessarily
Yeah,
for the
because
right audience. But until we make the term across the reports, I like to have the terms match when you're reading.
What are the
Yeah,
others
net
called?
revenue,
What are the
really.
others called on the financial on the statements, do you know?
I don't know if they look right at,
Okay.
I'll go back
We
and
can
look,
look.
but
Or if you look at like governmental financial
Yeah.
accounting standards, what term do they
Let's see,
use?
let's see what the auditors use too.
Yeah.
Okay.
That's actually.
because we're not really a COGS oriented company,
Yeah,
right?
because that jargon.
we're not a profit-oriented company.
Right.
We're also
Well, we're not-
not-
That's why that term
We don't
is
have the
jargon.
We don't have
Cost
costs.
of goods sold such a small percentage of the revenue.
Yeah.
So I think
understand
that is definitely something we can talk about nomenclature. As we get into cleaning up all the reports and making them, as we start looking at this package, what it really looks like going forward, once we get the report writing all fine tuned, we can work on some of the nomenclature.
Okay.
It's also in the mutuals, and that's gonna cost.
Yeah,
Okay,
okay.
Yep.
But that's why you see gross profit is because of the cost of
I
sales.
understand the accounting stuff, but
Yep.
it jarred me too.
Yeah, sorry about that. It's not me, it's
Just add the two lines above it, revenue and then real cost of goods, and then you could say gross profit.
Mhm.
Then it would be a little clearer what
Right.
that really
What that
means.
terminology is.
Yeah.
Is that too long?
Todd,
Mhm.
do we have the ability to change the sign convention on this? Because
Okay.
I've always used the convention that
So this is.
negative variance is
okay.
bad and
Right.
positive variance is
Right.
good,
So-
and the column will
Right,
add
and
up.
here it's not.
So that is, you know, that is, so the question with this is, do you want to have a reverse sign and logic on expense versus revenue, right? So do you want to have, if you're over revenue and it's positive, is a positive variance? If you're under expense, do you want it to be positive as well, right? And surplus versus shortfall. So right now, once again, all the NetSuite math does just a variance, okay? So what you see here is if you're under expense, it's an under. And if you're over in revenue, it's a positive. We can actually,
Can you flip those two? Or two columns?
we can flip, for right now, it's just a variance. If you flip it,
If you put
right,
budget
you're gonna
first,
have,
and
Well,
then actual, yeah, and then you see whether it's above or below. Above or below budget.
So what's the
but your point is, I want to move to a clear definition of, instead of a variance to amount, surplus versus shortfall.
Yes.
Right? That is the next version of report, right? Right now, we just understand you need to look at it and it's a variance. And right now, if it's on the revenue side, we're over, it's positive, and if it's on the expense side, if it's negative, we're under.
Right.
Right? So it is, once again, just one of those fine tuning things. The reason it is like this is so it currently matches the way NetSuite's output is until we obviously get in there, and we have the ability to customize the report so the signage will get to a surplus shortfall, which I think is easier for everyone.
But you're saying if it's negative, we're under, which is a negative
expenses.
variance is a good thing.
On
And we-
On expenses.
On
Yeah, I'm
expenses.
talking about expenses.
Yeah, on revenue it'd be, it's the
So you
same
couldn't
math.
add this if you, so it's gonna stay the same as it is? Here, like I look here, I've got 656 at the bottom and it doesn't add up that column, so that's what I'm disturbed about.
Mhm.
What are you looking at?
The main page there,
Yeah,
There's a
difference,
difference.
yeah.
the
The
difference.
The reason it doesn't add up is because if it's an expense, you've got to multiply that number by -1 before you put it
Yeah,
in.
exactly, which is irritating.
Yeah.
So I don't know,
But
it
does
just.
somebody just
It's the actual minus, it's the actual minus a negative.
Yeah, so you're
I
taking,
understand what it is, I'm just saying my
It's-
preference is to look
I
at it
agree.
like a negative number is a negative thing.
Negative, I agree.
Yeah.
I agree. That's the way we need to get it eventually, right?
Yeah.
I've always
Yeah.
had budget first.
People. do.
Yeah.
I've always had- No, we always have the actual first, because that's the most important thing.
yeah,
So actual's always first.
right. All right, so
All right,
656,000 positive, which is a positive variance, which means we're over. All right, what I want to do in the detail is we get down to, yeah, on the insurance, you'll see the insurance has we're over by $300,000. And I'm gonna just flow to the detail really quick so we can, and just so you know, this package, we're gonna continue to refine the reporting packages, right? And so obviously, as we're in the new system, so we will get into the activity for the month. We'll get into, we're gonna continue to refine these. Obviously, we're playing catch up and we're getting everything through June, so there's no point in putting June month in here. We're just getting to year to date, right? Okay, so if you look down on insurance, in the detail, let me get down here. All right, so if you look at insurance, if you look at,
78,
yeah.
78, very bottom.
Right.
4 out of 5.
So if you look at the general liability, 225,000 overspent, and you look at the DNO being 156 overspent. Those are actually accruals that were not reversed in June. We have some pending litigation that we accrue and reverse the accrual every month. So those will be fixed. So there's 275,000. So technically 150,000 in the DNO will come off and not hit the financials, and another 125 on the general liability for 2 pending lawsuits.
Okay, so you're saying instead of being 656 ahead of budget, we're really 656 plus 275?
Yes,
So,
Oh, okay.
okay,
that is correct.
so that's almost $1 million.
Been settled.
They
That's
have
almost
not.
$1 million. That's almost $1 million.
They have
ahead
not,
of
so they're
budget.
not booked, huh?
656 plus 275 is 9.25, so
Yeah.
we're 925 ahead of budget.
And I even have better news for you. We also got the insurance rebate check, which will post in July. So the total check was 1,275.
Okay.
We will take about 100,000 of that. The rest goes back to the
But
mutual.
that, yeah,
Okay, so we're.
that's not all us.
Yeah,
Only 100,000 is here.
so we're roughly $1 million ahead of budget, and you're saying most of that is timing?
Yeah, I mean,
So if
we're
you
gonna
go.
catch up on a lot of it.
If you go back up to 7,200 facility maintenance and 72,099, this is what, one of the topics you had last month, trust facility maintenance.
Right, we should spend
375
all
versus
that.
5.1.
Later on in your agenda, there's an
Oh,
item
okay.
to
All
approve
right.
That expense.
slurry seal of
All right, so,
280.
oh,
So you're gonna.
so don't get too excited here.
There's-
Yeah, you know, I know where it is.
Well, it's certain,
Yeah.
You can see what I put down there.
I will say though, it's certainly healthy having $1 million going into the
But
last
it's
6 months.
also, let's not.
We're not,
Yeah, don't run.
don't write that
count
check
the
yet.
money, yeah.
Yeah, we're not writing that
Yeah.
check.
So, but that just explains the importance of getting this budget
Season.
seasonality.
Yep.
Correct, because we can go through and have all kinds of significant questions on the differences, and 80% of them, the answer is gonna be timing.
Right.
And we need to get that. I do have one question though on the bus grant. So we have a budget amount and the amount is zero on the revenue. Is that gone and we shouldn't have budgeted that amount, or is that coming, timing also?
Timing,
Timing, okay.
the actual invoice for that is just going out the door.
Okay, perfect.
We should see that probably show up either next month or the month after.
Then all of a sudden we'll have a positive variance and then we'll go down.
Uh-huh.
Okay, yeah.
Yeah.
So that's just, we gotta get that, Todd. That's gotta be a top.
Yeah,
Very high
that's gotta
priority.
be a priority.
Talking about that bus grant, how long does that continue?
So the current, it's through Measure J with Contra Costa County Transit Authority. And we received a 2-year cycle. So it's 24, 25 through July, and then 25, 26. And it's about 112,000 a year.
And will that renew after that, or is that, or? do we-
So we've been applying for those funds since I think 2012 and we've been receiving them pretty consistently. The amount varies a little bit, but we've been pretty fortunate in continuing that source.
Okay.
And they still have the program.
And CCTA itself has the authority to disperse those Measure J funds, is that correct?
So within Measure J, that's the sales tax measure. There is a minuscule line within that whole thing that is for senior and disabled transit operated by basically nonprofits. And there is an amount in there, and we apply for those funds. We're one of several applicants, and we've been receiving it, and it is administered through CCT.
Okay, anything else on these financials, Todd, on the Walnut Creek, you wanna go the property?
We got a property management, out here, you're gonna see fairly consistent, real quick.
Same thing.
And just because you brought that up, I was gonna see if Kelsey's around, now that I have the June to get the report on the.
So where are we going now? Oh, RPM.
Yeah,
Okay,
yeah,
thank
I
you.
talked to her yesterday, but
And Todd, how close are we to a balance sheet?
we
on
are super close.
Walnut Creek?
Yeah, we're super close. A lot of the balance sheet, it all just will be completely fixed, once we get the audit.
And when is the timing of the audit?
We're still planning on, the 18th.
Because the audit committee meeting
Yeah.
was canceled on the 11th.
Right, yeah, so the 18th is the new date. I'm getting confirmation from McCarran, and they've been working on it diligently, so.
The 18th is when we expect to get preliminary? Okay,
In hand.
in hand.
Mhm.
And that's just for RWC, it's not for everything.
Not for everything.
For the
It's-
mutuals, for.
The mutuals are all separate entities, separate audits.
Right.
Those are all flowing in right now, completely separate by mutual. This would be the consolidated like we've seen in the past, right? So,
Okay, can we talk about scheduling a
Yes.
meeting on the audit
Yes.
committee after this, please, the three of us, Deborah?
Yeah.
Yeah.
I would love that. I'm ready.
okay, let's switch over to RPM.
Okay,
So that means hopefully next month we have balance sheets and everything. Okay, great.
Yeah, it's gonna be fast and furious going forward because of all the budgeting and everything.
Just don't plan on any vacations.
I haven't.
Get sick.
I have one
No
next,
sick leave.
I'm planning on one next year. Okay, so once again, very similar, everything I said about RWC is very similar on the property management side. Obviously, the same budgeting issues, the same budget to break even, and we're running a surplus right now of 287. That also has to do with timing on a lot of things, and so obviously the same things in terms of reforecasting, taking the June numbers and actually coming up with our year-end number is very critical. So there's no real surprises for me on this month, year to date through June. I mean, the variances are all pretty, they're not really any large ones that jump right out. So I don't really have a lot unless there's some individual questions on this. And there's no real deep commentary on some of the, on that variance. I mean, obviously, we are, over on the billable services and the reserve side. So we can, you can look at those differences. There's no real big surprise here, though. I think the most important thing is just, like I said, really getting into, you look at our biggest piece of it, which is personnel. And even though, salary wages were within $76,000, I mean, on 5.3 million. So I don't have any real further, enlightenment to share on this, other than I think next month when we start looking at the year-to-date numbers and also completing last year to see exactly where we are once we finalize the audit. It's going to be critical.
Yeah.
Any questions? If not, if we could move on to your cash.
Yeah. So I wanted to, on this one, just show you guys, I know we've come up in the last couple of months, so I kind of think, and I think this was either Adrian or Dan, but, I thought I might make this bigger. So we're gonna, obviously, when we get into next month, we start looking at the balance sheets and getting back to the trust balance. I went ahead and put in the 3 leading months, so we have a comparison. We've talked about that, so you can just see the change in cash balances from April, May, June. I'm kind of looking at the last 90 days. We still, once again, I think that the critical thing here on our cash flow planning is some of the similar things we have in terms of, what is our investment strategy? How do we look at the brokerage? How do we ladder our funds? So right now, the feds haven't dropped the rate. We're not losing any money per se, right? And I think if you start looking at the need for us on the finance side to really project our cash needs, right? And we have some big swings in between these accounts on intercompany, with payroll and everything else, to really, as we circle back around on the brokerage accounts to make sure that, and the reserve dollars we have, it's really gonna be kind of a new, I would say, culture, is to look at that investment strategy going forward, having that better forward-looking cash flow and knowing exactly what we can invest and tying it into the Ann's work on the CapEx, right? So there's a lot of work we still need to do as a committee and myself in terms of delivering long-term financial investment strategy on some of the brokerage accounts. So right now it's a status quo in terms of, where we are from last time. We're not in any financial risk. Our cash balances are good. And it's really about how we look forward now with them and making sure we have better cash planning.
Where is the cash in the LPL brokerage? Is that just in money market account? Is that what you're saying?
Yeah.
In the 4% or whatever
Yeah.
it is? Yeah.
Money market sweep. So you can see,
Okay.
the
1.62.
4.62, which will be coming down, I think, slightly, but
Okay.
yeah. And I mean, I think that it's premature right now, given everything on the table and the bandwidth and the forecasting done. But I do think just like the critical thing with all the mutuals we look at is one missing piece is that how do we invest our funds and what is an actual, more of a deep dive on our investment strategy and where the money are invested, how they're invested. And I owe the committee to bring that to the table. It's just, I gotta get my balance sheet out first.
Okay.
Any questions on this? All right, great, thanks. All right, Ann?
Can you drive for mine? You want me to
I'd
pull
love
mine out
driving.
Since you. Keep it up there. Oh, you're there. It's already.
Sounds like,
I'm just gonna
sounds
make
like
it
a
now bigger
that
for
sounds like a control issue, Todd.
Yeah.
you. I have, they're quirks, they're not issues.
Oh, quirks, not issues, okay.
So going through the sheet, we're actually gonna have a lot of discussion about this at next month's meeting. Again, no movement yet on any of those ongoing projects in the top three, the pavement, building finishes, and roof replacement, but we're gonna bring some updates to that next month. As kind of part of the next thing, pickleball. So I think everyone knows that they're basically negotiating with the contractor of preference right now. And again, in August, we're taking the full cost, of the project and adjustments to the capital, proposed adjustments to the capital budget for review for all the committees and the board. Do you have anything for MOD replacement?
Done at this point.
Okay. So for food and beverage capital projects, so the funding that's in here was to pay for the consultants to continue this phase leading us through the RFP process. Yesterday, we had the last of, or the most recent tours of the facility. We have 7 very interested and qualified parties that are looking to submit proposals for food operators. So we're really excited about the response and looking forward to seeing where that progresses.
So what's the estimated timeline on that, Ann?
So the RFP, it will close the middle of August. And we're hoping to work through negotiating the contract and bringing something back through the committees no later than October, even if we need to maybe do a special board meeting, so. But the idea is we really want them to be under contract by October, so we have time to work on transition.
Okay, thank you.
For the lawn bowling, so there's been no movement on the lawn bowling green turf conversion. That was something that in the prioritization was pushed into the last quarter if we proceed, so we'll be talking about that. The golf course lake liner replacement. Right now, there hasn't been much activity on that as we transfer to a new project manager. That's gonna be on the agenda later today. I don't know if Todd has anything for NetSuite implementation. What I can say to that is we'll be bringing some of the other components that are related to it with myrossmore.com and Vermont Systems, which is the software that we've selected for all of the resident services replacement. So that'll be coming again. So August is a really big capital month, just so you know. And then the golf bridge replacement, much of this that's in here under proposed is deferred into next year. We won't be getting into construction into next year. We'll talk a little bit more detail as refined, like the numbers, again in August. And everything below that, except for pool replastering, that's scheduled for the end of this year. So there's no activity on that. And the median turf replacement, I don't believe there's been any activity on that as well. I'm gonna check with John T. Usually he'll do those types of projects in the very end of the year, like sometimes October or later. And then the rest of the projects were things that were just holding patterns, things that were not put in the priority loop, but projects that have been kind of on the table and they haven't been totally eliminated, but they're things that will be kind of part of, up for discussion again as we enter into the next year's capital process. So I'm happy to answer any.
Yeah, I'm sorry, on the pavement program, is that out for bid?
Which one, I'm sorry?
The first one, the pavement program, the 900,000?
We actually went out and got the bids for it and we want to take that to the board in August.
And that number is reasonable based on the bids?
Yes.
Great.
Yeah, a little bit of savings too.
Okay. And again, just a conversation we had earlier, the slurry seal is not on this, that's
Correct,
operations.
that's operating.
The pavement is in
It's
this.
capital.
Perfect, okay. Any other questions? we're looking forward to the next month's discussion on,
Capital.
especially, by the way, a lot of people in the community are waiting for next month's on the pickleball.
I know they are.
I get bombarded with questions. I said, talk to
Me too.
Ann. Talk to Ann.
Yeah, thanks.
I do have a question about the NetSuite. How we ended up identifying what part of that was capital and what part was operating? Because we originally had a budget around what we're going to spend on this implementation that involved both a capital and an operating expense, and I've never seen anything that sort of tied it back to that. I'm not sure, you know.
Yeah, so, I mean, obviously, we are in a pretty good place now in terms of all the, I would say auditor agreed upon, capitalized implementation invoices this year that are hitting the balance sheet, right? Which is also why we need to get to the, obviously, that reporting. When we see the 24 audit, right, we're gonna make sure everything's classified, and that's part of the exercise they're going through, right? With this year's audit is making sure that we've classified that, but it's been pretty clear in terms of what we're expensing and what we're capitalizing, right? Obviously, a lot of the work this year has been on the implementation side, so we're actually using these dollars more than we did in the prior year where we were really just getting off the ground.
Yeah.
So I think we're gonna be pretty clean on that, Adrian. But, looking through the actual expenses through June and being able to then look at where we're at. We have a couple other things now, like Ann said, with Vermont and some of the other stuff. So, recapping all of that IT, we talk about NetSuite, but there's a lot of different pieces to it. It's kind of a catch-all term because Workday planning's in there too. We're implementing the budgeting piece. The subscription piece obviously was completely budgeted for. Implementation cost of that is pretty minor, but it will go against, this NetSuite, line item. It kind of includes a lot of other things. And so we'll break that out, here when we're meeting this week on that, actually.
Okay, so
So we'll get a breakout.
next month,
Yeah, I mean, I have it all by vendor and I know what they've worked on. So
so we can see the total budget and how much is capitalized expense and all
because the
that.
other part, like within NetSuite, there's a field service management piece right now in phase 2 we're working on that's gonna take us through the end of the year. So, there's.
I understand, because if we originally approved this whole conversion, we had sort of, we put together an estimate. It was obviously a very broad estimate. And we identified the sources where we get that money from. Some of it was coming from an operating surplus that we thought we had in 23, I guess. And I can't remember all the details, quite frankly, but it'd be good to know that we've lived within that boundary.
Yeah, and I think, Adrian, I think too, getting the final audit in their hands and closing out last year to see what those real surpluses were that,
Yeah, I understand that we sort of need to do that, but just to make sure that we can, when we look at backwards at this, we can say, yeah, we actually did what we said we'd do.
Yeah, that's my plan.
Okay, MTF activity.
So in this report here, we see that the number of sales is flat with last year. However, the number of fees collected is down by 6. Not sure if that is people are transferring within Rossmore more, or exactly what is causing the increase in the number of exemptions. But overall, we are at 247 sales, 193 fees collected, still ahead of last year's pace, but we have seen some leveling off over the last few months. It'll be interesting to see how that transitions based on some of the updated economic news over the next few months through the summer. If there's anything specific you'd like to go through.
And Todd, so still on your agenda is the breakdown of the exemptions
Well,
By month and
we've had the
year-to-date.
breakdown. My thought was, obviously with Sophie and everyone's, we have all the definitions, all this, but to do a year-to-date June recap,
Right.
to actually look through half the year and then,
That's still on the agenda.
yes, 100%.
And what's the status of your FP&A hire?
I'd love to talk about that. I'm hoping you have an offer go out this week.
Okay, so you have some candidates you're interested in.
Oh. Yeah, so that's actually just in time for budget crunch season. Yeah, that's been a big hole.
Throw them into the
That's been a big hole. Big hole for me to fill.
At what point should we talk about any changes to the MTF?
So I think that is an item that, as we mentioned in August, is gonna be kind of a big capital month. And there's a number of things in play. And planning is also starting to talk about the projects as they are related to the facilities master plan and doing some review of those. So as we know what the overall list of projects is, the cost impacts, and what kind of cash we'll need to address those, that's when I think we need to come back and really evaluate what that MTF needs to be.
Maybe October?
Yeah, I think over the next 3 to 4 months.
But I think we also have to talk about the FUF fees and whether those should be moved out of operations into capital. We need to do that before the budget process starts.
It'll be
Part of the budget process. So
we'll need
that's,
to have that very soon.
so should we put that on the agenda for next month?
Yes.
Okay.
I'm sorry.
The facilities usage fee?
Yeah,
Fuff.
FUF.
FUF.
You wanna have fun, you have to play fuff. I don't know.
I like that as a slogan.
Wow. Okay, we're gonna just move right along.
Better start talking or it's gonna keep going.
Todd, anything else any other questions on this, on the MTF? If not,
Okay.
all right, Todd, anything besides what you've talked about on NetSuite update?
Yeah, I just I think it's just really, we keep talking about this year being a transformative year. I'm gonna probably put out, I'm gonna talk to Ann Peterson and put another NetSuite news out in August article. I think Workday Adaptive, is we're kind of moving into the value of that. And my backside job has been working on the implementation of that for this new season. And I think everything we talked about today kind of speaks to a lot of the reason we're moving to these new systems. As much as it's been very painful, when we look at the insurance modeling, we look at the cash flow planning, we look at investment, all these things are going to be made possible given forecasting tools that we've never had. So as we get into this budget season, we've turned the corner for the most part on all the NetSuite stuff. We still have field service management to go, but with Workday coming online and being able to really seasonalize the budgets, look at history, apply some AI thinking to how we look at the spread on the months, have the capabilities to do that forward planning, not just from a P&L standpoint, but also from a balance sheet and cash flow. It's a critical change for what we've done. And, that further outlook, these tools are gonna be able to get us there. And so I just don't want to lose sight of that because we're right in the mix of it as we shift from these June financials into actually creating that next future version of what our forward plan looks like. The commitment of this committee and the board for these new tools will make that a reality. And there's a lot of work, and I know there's been a lot of frustration, but we're gonna have tools we've never had, and it's really exciting. So.
Anything from the planning committee? Anything else from the planning committee?
I know Dwight's listening in. I don't know if he wanted to say anything. I tell you, we are working, we're actively working on setting up the framework for the capital budget. I think this is some kind of interesting work the committee's doing. So Adrian and Ted are a subcommittee working on making sure we have a really clear priority structure. And Janet and Dwight are working on the actual process itself, because we want to make sure it's really transparent without process works from an idea of a project through getting it reviewed by the board.
I don't
Good thing
think,
you reminded me.
I don't think we have any other questions. I'm gonna skip.
You
it for
forgot.
now.
Absolutely.
Let's go to nine, C. The, contract for the
Yes.
slurry seal project. Ann, you want to take this?
Sure, so I mean, we tend to, we have a lot of roads, and we tend to, look for, so what Martine does, he's always kind of tracking the roads and road conditions. And annually, we look for different sections of road that are in most need in order to extend the life, the preservation of them. And so, there's a map attached to the staff report, which shows the sections that we're looking at,
Can you
that
pull
have been
that up?
identified.
Can you pull that up, please?
It's,
Oh, here.
it's attachment
It's on the
9C.
9C2.
Oh, I can just open it.
And then scroll.
Yep.
And the sections of road are on Tice Creek Drive, Oakmont Drive, Oakmont Way, and Pine Knoll Drive, and he.
You gone too far?
Yeah, no,
Wait,
There you go.
There you go.
there. No,
The other,
the map,
yeah.
all right.
and so, again, this is in the operating budget. It was programmed in the operating budget. And I know we talk about seasonality, but particularly like Martine is an impeccable record keeper, budget keeper, and tracking the expenditures through the year. And so this is, again, what's proposed for this year. And so he did receive 3 bids.
Yeah, can you go open the other one now?
Sure.
So the budget was how much this year?
So total with contingency is 294,000.
The approved budget,
Improvement.
the original.
We don't
For
approve slurry seal, we approve that whole line item of the 800 expenses. Because you don't know until you put out for bid what's gonna happen, we have a general idea of what the expenses are.
What's the rough amount of money spent year after year after year? Is it 80,000 in ballpark, or does it go up and down?
For the slurry seal?
Yeah, for the slurry seal.
Portion, it's varied. We try and normalize it as much as possible, but it varies. One year we did a pretty significant run on Rossmore Parkway, but in general, we try and keep it pretty flat. And a lot also depends on the environment for the oil and
Yeah.
Mhm.
supplies.
So there's the bids,
So the bids are pretty close.
and we've used Silicon, you've used Silicon
We've used them
Valley with-
successfully
yeah.
in the valley, yeah, for a lot of our different work.
Any other questions on this? If not, you want to take over the new Mary?
Beyond my capability. Okay, so I move that we recommend to the board to approve an expenditure not to exceed $294,000 from the operating budget and authorize the general manager to execute the contract with Silicon Valley Paving for slurry seal project.
Is there a second?
Second.
Second by Kim. Any further discussion? If not, let's take a roll call vote, please.
Certainly, Ring,
Yes.
Star,
Yes.
Castillo,
Yes.
Hines.
Yes.
Jennings.
Yes.
And Byram.
Yes.
It's unanimous.
Great, thank you. Jeff, I guess you're doing the next one?
And
Ann's doing that too, okay.
Yeah. So, for those in the room that are not aware, on some of our more complex capital projects, we use the work of a consultant project manager who tends to have the type of engineering expertise that we don't have in-house. We don't have that talent in-house. And it's actually a very economical way to do things because it's project-based, paid for by capital, versus, having full-time staff. So the gentleman that has been really wonderful to work with for years, Fred Pons, is retiring, semi-retiring, kind of scaling back. And so we find ourselves in need of a new resource to assist us with this. So we found so there's a company that, basically I've actually worked with them also in other agencies. And we're proposing that they come in and replace that work. The format's a little different and actually gives us a little bit of a different process than working with Fred. So Fred, he usually builds, depending on the year, like if we're in active capital, like building and whatnot, which we are this year, the high end was about 80,000 and it could have been as low as like 65. And we have some rather complex things coming up that we need to navigate through. So what we want to do is set up a contract of not to exceed 80,000 per year. To have him be the cross between the project manager and the owner representative. And the difference is, as the owner representative, is when you have active construction, you need that person that's holding everybody accountable and can see some of the technical stuff that us mere mortals cannot see. So the way Consor works, and we put their company profile of the team that would be assigned here. The way Consor works is rather interesting, where they have like the principal lead who is like the most, would deal with the most technical aspects, but they can hand off to people that bill at a lower hourly rate for the project management and the administrative. So while the range of fee is a little bit higher than what Fred's hourly was, it will norm to probably be as efficient and maybe even more efficient than what we used in the past. So hopefully that's a little bit of an explanation of
Did we,
what we're trying to do.
did we bid this out to anyone else? Or is this the only person we went out to see, to get bids from?
We actually, because of the timeliness and kind of the exit was coming at a short thing, I went to somebody that I knew could be successful here. Because right now we're navigating through something without the expertise in hand. So it's a little bit of
What project is that we're now,
a pickleball project,
pickleball project?
pickleball, yeah.
So these
There are
people.
a lot of things that we're trying to intertwine right now. When you have the bid in and you're doing, they call them exceptions and qualifications that you have to negotiate through. We're in a real critical path to be losing somebody and to kind of be stepping forward.
And then the other thing I question is the amount not to exceed 80,000 with an hourly rate. Are we just gonna cut them off when we get to 80,000? Is that how it's gonna work? Even if they're middle of a project, or how?
No, I mean, we would need to come back, but the issue is what we do is before a project, we would go to them and just say, look,
Give
this is
us-
a project. They kind of have to estimate what it is. So you know before you step off what's happening. So the first thing that they would need to do is to say, so this is the construction project that we're dealing with, you know? So we have that. They'll probably get the handoff for the lake liner and the bridge, because those are the more technical projects that we have going right now. And so we would need the proposals for those. But it's a very dynamic, so one of the things that which is very unique here, we're very dynamic, the way we look at things, the detours our community likes to take on certain projects. And so to have Fred that was on call for these things, it's a very unique type of a contractual arrangement. It's an on-call service. And yeah, we're gonna have them estimate project to project. But again, these things will pop up. You get blindsided with highly technical things that can impact all of these regulatory agencies, and you really need to have that expertise there. So you project the budget to that extent possible, but you know that you have your phone a friend that can actually help navigate you through the hot water. Sorry.
So Anne, how much had we been paying the fellow Fred annually?
It ends up, like, it's been anywhere from 65 to 80,000, depending on the year and the projects.
And
He
he's
bills it like 200.
He's retired, he's gone now?
And he was independent, he wasn't with
He
the
was
firm?
he was a single operator,
Okay.
And what was his hourly rate?
200 an hour.
And so in looking at the fee structure, it does talk about, not to exceed task orders, lump sum pricing, et cetera. Do we choose the structure, or do they choose the structure based on the project?
So they have to choose the structure based on the product, because we can't say, well, send me your admin to deal with the environmental agency. There are certain things that they can do, right? But there's a lot of the work that has to happen from like the upper level.
No, I know, but
qualified people.
But on a project, it's different doing a not to exceed task order than based on hourly billing or on lump sum pricing, right? It says depending on the scope and duration of the assignment. So are they coming to us saying, we're gonna do this on lump sum and here's our price? Or is that something we get to choose?
It's something we would negotiate.
We would negotiate, yeah.
Okay.
This will be an actively managed contract based on our needs for specific project capital
So
projects.
what you're saying, as I understand it, is that when we have a particular project,
Like the pickleball.
yeah, we can
Right.
go to them and say,
Well, yeah.
okay, what's it gonna cost you to deal with that?
Yeah.
And we get a fixed total price for that.
Yeah.
And then if we needed them because something else went wrong, and we needed help right away, they just charge us the $250 an hour,
Yeah,
$200 an hour.
this is
It's-
basically to get them under contract
Yeah.
so we have the protection and the coverage of
Yeah.
a contract. And then based on the need from various projects, we will
Yeah.
work with them.
Okay.
Because and I really need to emphasize this, there needs to be a fluidity. We need to be able to call this person, it could be something that came up that we didn't get an estimate for, right? And
Yeah.
so that's what we do, we manage the total, we manage it to the total amount there. And again, we've been doing this with Fred for how many years now?
Yeah, quite a few years.
So I mean, it's not a new way of managing
And
a
if we were
resource.
to, we had well, like a pickleball project or anything else, we know we would use their services, we would need a certain amount of their services.
Yeah.
Would the cost of that be in the 80,000 that we're approving here, or would it be built into the cost of the project?
So what we end up doing is like Fred's time is charged to the different projects he's working on.
So this 80,000 will be allocated based
distributed.
on what project they're working on. So it won't be a separate line item, it will be built into each capital budget,
Okay,
or it already is part of
It
it.
already worked.
yeah,
Hang on,
okay.
hang on.
Okay.
There was a question.
Yeah, Janet.
That was a question, is there a reason why, since it's a new vendor, you wouldn't do a 1-year contract instead of a 3-year contract? In case it didn't work out.
Well, we always have the out. We still have the out with a 3-year contract,
In most capital projects, bridge
bridge year to year.
number of years, so we want consistency with that relationship.
So my question is, we're approving this $80,000 per year, which is sort of a bridge across projects. And then in the event that, say, pickleball requires additional services, they're gonna provide us with an estimate of those
Yeah, we'd have to come
costs
back for
in
that.
addition,
We'd have to come back and approve that separately.
separately, right?
So my only concern is that we didn't go out for bid on
Yeah,
this.
I was.
One of the,
And I understand why, because the pickleball is hot and heavy, but I still,
yeah,
Well, and getting to that, I went through some of their qualifications. My concern was that one of our major challenges here is our creek and the multi-jurisdictional span of agencies for doing anything around that. And these guys don't seem to have those qualifications.
But, I
Are
mean,
you
I will say
pretty
they actually do.
Okay,
They're not gonna, so something like, putting something like that, like it's implied by their background, the educational background, the places they work, that they've had to work successfully in that.
oh, I
And
saw
again,
on it. JL.
so for instance, if you look at the projects they worked on, they actually had to navigate through those things for the successful completion of those projects.
Okay.
I mean, so that has been confirmed because that is a big issue that we have. And I know, certainly working with, and that to the layer that Army Corps of Engineers that we don't, I mean, they've even had to work to higher levels.
okay.
Okay,
Any further discussion?
let me make a motion then. I move that we recommend to the board that they authorize the general manager to execute a 3-year professional service agreement with Consor for capital project management in an amount not to exceed $80,000 a year.
Is there a second?
Second.
Any further discussion?
I just want to put another question.
Yep.
Would you be using them for whatever happens with the MOD building and all that too? Is that a whole other
that'll be a different.
separate?
Any other discussion? If not, roll call vote, please.
Certainly. Ring,
Yes.
Star,
Yes.
Castile,
Yes.
Hines,
Yes.
Jennings,
Yes.
Byram.
Yes.
It's unanimous.
We're gonna do you now. You gotta be quick.
Next meeting.
Yeah,
Okay.
well, probably maybe two.
Absolutely.
All right,
That's
we're
fine.
gonna, I know people are gonna be upset with this, but we're gonna move the charter and basic parliamentary procedure overview till additional, maybe in September.
Okay.
Uh,
I read it and it's very well done, so.
Then you're one step ahead of me. Anything else? If not, I guess we are adjourned. Our next meeting is August 26th at 9 a.m.